All right, welcome back. So in this one, we're going to prepare another adjusting entry for Misty and Brock. It was August 31st was their end of August. Okay. So now they have some equipment. Now think back. Sometimes it helps to think of the original entry that we were doing in chapter 3. If a company buys equipment, they debit the asset, equipment, and let's say we paid with this equipment with cash. Maybe we bought a brand new computer, so we put it to the equipment account. Okay, looks like we purchased it for $80,000. It probably wasn't a computer then. Maybe it was a Tesla. I don't know, company vehicle. All right, it's gonna last 10 years. Okay, so when we purchased it, we correctly categorized it as an asset because we hadn't used it. When we bought it on, let's say, I guess it would be August 1st, because it said it was bought this year. So let's say we bought it August 1st. On August 1st, we couldn't use up that entire Tesla, their entire useful life in 10 years. You know, we drove it 200,000 miles on August 1st. It's no good anymore. No, of course not. It still had a very long useful life remaining. It still had value. So that's why we called it an asset. Now, eventually, over its long life, over 10 years, we're going to use it up, right? We're using it up each year. So as we use it up, we have to record that usage by increasing an expense account. Okay, so that's what we're going to do here. Now, whenever we're talking about equipment, you're going to use a new account called depreciation expense. Treat it like any other expense account, right? That means it goes on the income statement. It has a normal debit balance. So that's going to be our debit here because we want to increase it. Okay. Now we have to figure out the amount. Sometimes they'll tell you, sometimes you'll have to figure it out. Now, $80,000 is the entire value. Okay. We need to systematically allocate that to each period. Right now in this, first, what are we in chapter 4? The easiest way we're going to do that is just evenly divide it. Okay. So you're going to take cost and you're going to divide it by its life. This is going to give you life in years. This is going to give you your annual depreciation expense. Annual depreciation expense. Okay, so let's go ahead and start our formula. 80,000 should last us 10 years. That's $8,000 per year. So each year we use that company vehicle, we use up $8,000 of value. Okay, now look at this. We haven't yet used it for a year. We bought it August 1st and we're recording the adjustment August 31st. We've only had it for 1 month. So we can only record 1 month of expense. You can only record to expense what you've used. We've only used up 1 month. That's fine. We can prorate this. It's $8,000 a year. So just divide by 12 to figure out what is the expense for 1 month. Okay, so do that. Oh, that wasn't a very pretty figure, sorry. 8,000 divided by 12. So I'm getting, when you round it, 667. Okay, 667. We know we have to have a credit offset. What account are we going to use for the credit offset? It's an account that you have not seen yet. You have not seen it yet. It is called accumulated depreciation. So it's a brand new account for us. It's a brand new account called accumulated depreciation. It always accompanies depreciation expense. So honestly, you don't even have to think about it. If you're recording your usage of equipment, these are always your accounts, always. Okay, So we're going to increase it. First, let me tell you some fun facts about depreciation, such as the normal balance and the account type. Okay, so accumulated depreciation. Think about the accounts that we've seen. We've seen asset accounts, liability accounts, and equity accounts. It's really none of those. It's what's called a contra account, specifically a contra asset account. We will see many other types of contra accounts. This is our first one. Okay, contra asset. You've probably heard that term contra before, right? It's Latin for opposite, right? So opposite or against. So it's going to have the opposite normal balance. It's going to have a normal credit balance. So the opposite of an asset. Okay, and it's going to appear on the balance sheet. Why? Because that is where assets appear. And it's always going to stick with that asset. So let me show you what it's going to look like on the balance sheet. So if you were looking at the company's balance sheet, you would have your normal assets, cash, AR, supplies, the ones you were used to seeing in chapter 2. Now you're going to have equipment, okay? And then right after equipment, you're going to have this new account, less accumulated depreciation. So in this example, it would be 80,000 less accumulated depreciation of 667. 667. So 79,333 is what we call book value. That's your book, the value on your books of that particular piece of equipment. Okay. These are its traits. Here's how it appears in your journal entry. And then you, of course, have to have your explanation to adjust for depreciation on equipment. Okay, that's a lot to take in there. So go ahead and pause, update your notes, reflect on these new accounts because they're both new and on this adjusting entry. And I'll see you in the next video.